Okay, good afternoon. Can you hear me now? Good. User reacted. So good afternoon. Good sunny Thursday afternoon. Today's topic is shadow banking, which quite briefly it was mentioned on Tuesday when regulation was the topic. The question then that we ended was that you could say indirect costs of banking regulation, something that is you can't measure, but obviously the tougher you make the life of traditional commercial banks in terms of capital requirements or liquidity requirements or defining different limits to their operations in terms of organizational structure. Can they operate in risk-taking activities and so on or not? Reporting everything which have, as we have more or less we have been discussing every now and then, especially on Tuesday, the regulation has become more and more strict for commercial banks. The tougher we make the life for commercial banks, the more there is room for other institutions, other service providers offering the same or more or less the same offering for the clients without the regulatory burden that commercial banks face. Before going to the shadow banking, the question that was, I got an email, very good question. As such, you are too young to remember, but every now and then it could be that maybe your parents might refer to how the Finnish banking world looked in 80s until the 1980s, early 1990s. If you read, those of you who are Finnish-speaking, Björn Varus published the latest book is about the life as he was one of the directors in the leading Finnish commercial bank SUP at that time. So the book, he very much pretty big proportion of that book is about different structurings that this bank was active in different industrial companies in Finland. So that world is that was how Finland was until late 1980s. But nowadays the world is totally different. Then how the world was, it was that how it was like, it was that SUP as the biggest Finnish bank owned big proportion of shares and especially voting power in a few Finnish companies, such as Nokia, for example. It was one of the leading owners of Nokia. As one episode in this book was that as SUP was willing to sell Nokia to Swedes, but then Swedes were not willing to buy. Had that transaction been executed, so the world would look very different today. SUP had its own industrial companies on which they also held board seats. In many of them, they were the chairman of the board. They owned the big proportion of their insurance companies. Insurance company owned big stakes in these industrial companies and in SUP. The same for KOP, another banking group. Skop came as one a newcomer. They also wanted to build their own industrial group. later on kind of went bankrupt, the whole group, but that was totally different from how the world is today. Then bankers were the leading decision makers in industrial companies in Finland. And that was kind of those were the times of cross ownerships. So bank owned big stakes in insurance companies, in the industrial companies. Industrial companies owned these banks and back and forth. These in today's world, it sounds that is kind of how can that be? And yeah, nowadays it's kind of unheard of. All these kind of, you would say, ended, if not even collapsed, in the banking crisis that we had in 1992. 1992 Finnish GDP fell by 7%, which was in Western countries the world record of a loss of a GDP in just 1 year, and that was because the banking crisis we faced in Finland. At that time, banks were forced to sell all their holdings, more or less kind of all the holdings in these industrial companies. You might say that, okay, it doesn't make any sense. If you look at the Japanese system currently, the Japanese system still, it's called kahdeksikko system. So I was for more than 10 years, I was at the board of one Finnish company which was acquired by the Japanese Mitsubishi Heavy Industries. Mitsubishi is one of these kahdeksikos. They are groups which kind of they look and they act very much like the Finnish banking system was until the end of 1980s. So Mitsubishi has they have all different kinds of industrial companies. They own a Mitsubishi Bank, and Mitsubishi Bank is financing these industrial companies. So it's you could say that from outside it's pretty untransparent, but it seems to work. In Korea, it's called chaebol system. It's very much the same. The big chaebols are controlled by a relatively small group of people, typically a family. And they had kind of big banks, big insurance companies, and industrial companies within the group, which support each other. And it's very non-transparent. It's totally different from the US or nowadays Nordic system. Germany was more or less kind of, and still is somewhat like the Japanese system, but has taken many steps from that. So kind of now banks are focusing on the banking system, banking operations. Insurance companies are kind of insurance companies. Industrial companies are industrial companies, and so you could say that that is how companies are supposed to function. Does not mean, as there was an Economist article once some years back, which kind of pretty nicely kind of summarized by saying that economists, they admitted that they have for years, they have been criticizing Korean system and saying that it's inefficient, it's non-transparent, it cannot compete with American kind of and the leading European companies. But they admitted that kind of they have been wrong. They still do not understand how the system works, but it seems to work. So, same you might say for Japanese kahdeksikko systems, they are still alive and kicking, kind of and operating. It's just different. The whole infra, the whole setting is different than what we have got used to. Part of that, obviously, in after the global financial crisis, which is took place in 2007-8. Or the banking regulation that has kind of in today's kind of world, it would be very difficult to see kind of banks operating or owning big stakes in industrial companies. There is kind of the major unclarity comes from kind of a bank being both the owner and the debtor of a company. So then the question is that, okay, are we maximizing the value for the shareholders or maximizing the value for the debt holder? So that led to kind of a bit tricky situations. Nowadays, banks do lend money for companies, and shareholders are different groups of people: pension funds, institutional investors, retail investors, who are shareholders, and they want companies to maximize risk, to get the share of the upside potential, while debtor is concerned about risk, because the upside potential is limited, while the downside risk is that at worst the company doesn't pay its loans back. So the banks are in risk control kind of business, while shareholders are risk, say, in controlled way, risk maximizing activities. That is their goal. So in a way, that's the world that we know currently, and we are familiar with in Western countries. But as I said, different systems seem to work on their own way still. Okay, any other questions, comments from the regulation or something else? As today's topic is about shadow banking, we'll talk about institutions which are not banks, but kind of compete with banks. I guess that would be kind of to put that in short. So today we'll talk about the development of shadow banking system shortly, and then kind of subtopics. We'll talk about mutual funds and ETFs, hedge funds, venture capital and private equity funds, and investment banks. At the end of the lecture, we should be able to answer the questions: what is the broad definition for shadow banks? What is the difference between a mutual fund and a hedge fund? What do you know about the performance of private equity funds? And what are investment banks doing and investment bankers doing? Okay, let's move on. As a background, so still, and you could say that we have used quite big proportion of this course to go pretty extensively into banking regulation, history of banking crisis, and so on. And that is there's a reason for that. Banks still are the most important financial institutions in the world. So they are still highly relevant. But in recent years, one could kind of observe that the traditional banking business, especially in the US, has been in decline, or at least relatively in decline. Mostly like in Aktia's case, for example. So they have been actively trying to grow their other businesses than traditional taking deposits, making loans business. And all the new businesses that have not taken over but taken new market share, you would call it as a shadow banking system. Shadow banking, you could say in narrow term, refers to the process of credit intermediation that is conducted outside the regulatory banking system. Now, the key word here is credit. Bank obviously is traditional in a credit business. They borrow money. The customer becomes a creditor, and the bank makes loans, offers loans, mortgage loans, corporate loans. Bank becomes the creditor. So credit here is the key word. New operators have come this market, offering the same credit for customers and financing that by some other means than bank deposits, because these new institutions, they are not banks. But they also offer maturity transformation, liquidity transformation, credit risk transfer, or leverage. So that is in a narrow term definition for shadow banks. So banks use these short-term deposits to make long-term loans, maturity transformation. Shadow banks can do the same, but they are not subject to traditional bank regulation, and they can't borrow from the central bank. And they're obviously there is no need to decide about, say, deposit guarantee system, as it seems to be that we have ended up utilizing or employing in banks, as we were talking on Tuesday, to make depositors willing to deposit their money on the bank, even also those ones who are not kind of concerned or interested in comparing and analyzing which banks are healthy, which banks are not, to make everybody willing to do that. So we have developed this deposit guarantee system. Now the question is, in Europe, we still yet have not kind of adopted the European-wide deposit guarantee system, but we have a national ones which are different from each other, but essentially the key features are the same. In shadow banking system, there is nothing like that. So customers who finance shadow banks, that is something that should be aware, and especially as on Tuesday we were discussing about the financial supervisory authorities, which obviously are supervising banks. ECB, the biggest banks, national supervisory authorities come from the local banks, the smaller banks, said to supervise them and make sure that the offerings are according to certain kind of rules. These shadow banks, they are not many of them are not supervised by the financial supervision, which is something that customers kind of somehow overlook and not kind of consider or think that they would be supervised, but they are not. And as they are not supervised, so they are pretty freely do the kind of all kinds of stuff and say borrow money from customers at a seemingly kind of a safe offerings, which at the end of the day kind of could end up with being very risky without the customers acknowledging this. So, but this is just something that kind of you should always be aware of. Shortly about the definitions, Financial Stability Board defines shadow banks as all entities outside the regulated banking system that perform the core banking function, the credit intermediation. This is one definition. This is the narrow definition for shadow banks. And some examples have been provided by Financial Stability Board. But we on this course, we use a broad term, which is a somewhat different from Financial Stability Board. Broad term is kind of say more widely used, and we define it as activities that may consist of mutual funds, ETFs, today's topic, hedge funds, which is today's topic, venture capital, private equity funds, today's topic, investment banks, today's topic, and then fintech market, peer-to-peer lending, crowdfunding, which will be kind of the topic of next Tuesday. Insurance companies, topic of then week after that, insurance companies lecture, and pension funds will also be covered there. All these institutions, mutual funds, hedge funds, venture, blah, 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 they offer financing for companies and for households. So you could say that they are competitors to traditional commercial banks. And in that sense, you would say that in a broad term, these can be called institutions in the shadow banking business. So today we will cover the first four of these. As a kind of a verification that banks' relative proportion has diminished, become smaller in past 20 years or so. So this is from Europe. The panel A, the financial assets held by financial intermediaries. So you see that this follows more or less kind of this broad definition for shadow banking. The banks there, which are labeled by this yellow, is it yellow kind of the color, made almost something like 60% of the total kind of percentage of financial assets in Europe in 1999 has gone down to something like kind of a would it be 40 to 50% in 2020. Still, obviously, the most relevant in terms of size, something that we were discussing on the very first lecture, talking about kind of taking a look at these the relative sizes of different financial institutions. Banks are dominant still, but we have seen that insurance companies, pension funds, they're labeled with kind of the blue color, have remained, what is this, 10–15%. Investment funds have grown pretty much with the blue, and especially other financial institutions labeled with the green color. The B column there shows the percentage points change, first 2009 to 2020, how banks have the relative proportion has kind of decreased significantly, 15% in this time period. So banks have been kind of quite rapidly shrinking, at least becoming smaller relative to other institutions. So other financial institutions have become bigger, especially all kinds of different other financial institutions. And the euro system that has to do with kind of the more or less kind of the market dominated by European banking, European Central Bank. You might remember from the very first lecture, the second slide set, there I had this one picture from McKinsey on which I explained to you that the bottom part of this is on banking balance sheet. So these are personal deposits, banks taking in deposits, selling bonds, and some corporate and other public deposits. So this is how these banks take money in their balance sheet, and they forward those to in corporate and public loans, retail loans, and so on. So this is, so far we have been mostly talking about the banking, on banking balance sheet kind of a business. And on this market, the banking regulation has become more and more, say, strict. In shadow banking is on, you could say, something on top of this. This is roughly, this is global. This was European, this is global. In 2019, everything else, which is insurance and pension institutions, real assets under management, sovereign funds, and so on. wealth and asset management businesses, listed companies, clearing, settlement, securities services, investment banking operations, which in terms of total kind of assets is roughly another half. Why are such items outside the banking balances? These, if you just think of as one example, let's kind of try, if I try to clarify this, the first one, I hope this helps you, kind of a mutual funds, for example, they are off the balance sheets of a bank. So mutual funds, kind of very simple ways for anybody, for retail clients, for institutional clients to, which the funds, these offer kind of a retail clients and institutional investors and whatever investors, kind of the channel to invest in financial markets. So they pool these resources from many small investors, many small and large investors, and under a professional money manager. So somebody's profession is to act as a money manager or fund manager. And this fund manager decides where the pool of money is being allocated, in which shares, in which bonds, in which kind of money market instruments, and so on. They offer liquidity, automatically kind of diversification. Mutual funds can negotiate lower transaction fees. They are, as they say, they easily kind of manage, say 100 million is a small fund size. So the fund manager managing 100 million kind of portfolio can negotiate pretty attractive fees with the brokers and so on. And the money manager, the fund manager is a professional fund manager. These mutual funds, that is, it's owned by the shareholders of the mutual fund. It's not owned by the bank. The investment companies, say, or like Aktia, is not an investment company, but it's a bank, but it has a subsidiary, which is a investment company or mutual fund company limited officially. So they offer various types of funds, European equity fund, global kind of balance fund, and money market fund or whatever. And investors can move from one fund to another, typically without paying any subscription or redemption fees. But as the owners of these funds, European equity fund, global balance fund, money market fund, whatsoever, so many, so they are owned by the shareholders, not by Aktia, not by Aktia Fund Management. Aktia owns this Aktia Fund Management Company, and Aktia Fund Management Company offers these professional fund management services, reporting services, and all kinds of services for the clients. But even the Aktia Fund Management Company, their balance sheet is typically kind of very small, as they do not own these European equities, kind of assets in this global balance fund, but they are owned by these end customers. So instead of a customer putting the money on Aktia's balance sheet, the customer puts money on this mutual fund, which has a massive kind of a consequence for capital adequacy kind of requirement, as if it happens that the European stock market falls by, say, 20% or 30%, so who is facing this loss? So it is the customers, not Aktia. Aktia doesn't lose directly directly anything. Of course, indirectly, as the customers might be kind of redeeming their money out, and the assets under management, kind of the service, the fees are typically determined as some percentage of the assets under management. If the assets under management decrease by 30%, so say if the management fee is 1.5% of that, it also kind of the revenues for this Aktian fund management company also decreased by 30%, but no more, kind of year after year. But there will be no capital losses in the sense as a result of this, the market, the value of the fund going down. So that means that unlike for banks taking in deposits, making loans, and if they would lose 30%, so that would be a massive kind of a, so the customers would on aggregate say that we are not paying 30% of our borrowings. So that would be a massive crisis for a bank, and as the bank cannot be let to go bankrupt, as long as we are talking about the deposit-taking banks, so government bailout is needed. Nothing like that is needed in mutual funds, because the investors are taking the hit. That's why these are, you could say that, I don't know how, hopefully customers understand that, say customers of Aktia, customers of Nordea, customers of Goldman Sachs, they understand that when they invest in Goldman Sachs or Nordea's or Aktia's mutual fund, that money does not go into the balance sheet of that bank. No, it doesn't go. Not at all. It's a fee business. This mutual fund company charges this management fee from the service that they're offering for these clients. So that's why these are not in the balance sheet of the bank. The same applies for any other funds. The structure always is the same. So that's why these are not in the balance sheet. That's why, as Mikko was referring to this as a capital light business. So it's very light. The requirements are very light relative to the old-fashioned banking business. Sorry. Two different types of mutual funds: closed-end and open-end. And size-wise, nowadays, kind of most of the mutual funds that we are talking in Europe and in US are the open-end funds. So you can buy, you can sell them at any point. The price is determined by the net asset value. Closed-end funds, they are slightly different. So the price is determined by the demand and supply. And typically in closed-end funds, you find something called closed-end fund puzzle, which is that the prices of closed-end funds are typically at the discount. So investors are not willing to pay the net asset value, while that is the case in open-end funds. And we are talking about a pretty big market. This is from a International Investment Funds Association, the development globally of the regulated open-end funds, mutual funds. 2011, the market size was 28 trillion. So 2020, it had grown to 63 trillion. There are equity funds, so that is funds investing in the stock market. The biggest proportion of these, mixed, which is mostly kind of hybrid or balanced funds. So funds invest both in shares, equities, and in fixed income. Bond funds obviously invest into price in bond market, in different bonds, and money market funds invest in short-term money market instruments. So the market has grown globally. The total number of worldwide regulated open-ended funds was 126,000 in 2020. So if you compare this with, say, number of listed companies, for example, which are Helsinki 150 or so, New York Stock Exchange, Nasdaq combined 5,000 or so, less than 10,000. So the number of funds clearly exceeds the number of listed companies globally. and this would be listed companies only, kind of obviously different bonds, different money market instruments, but the number of funds is and has been growing, and has more than doubled in a 10-year. Another global kind of feature which kind of I find very interesting in terms of the number of funds globally. 46% are in Europe, while US is 8%. So Europe is European market, which is a we have one money market. We have Euribor is in Euro countries, is the money market rate. But most of the financial market, say the fixed income market, has there's a European level fixed income market. So in that sense, and European, so in Euro countries, so we have achieved something that was the goal when European Union and then Euro was adopted, to get a large European financial market, which could be competitive relative to American markets. In fixed income market, this has worked pretty nicely. But if you just look at kind of equity-wise, stock market-wise, so we are highly kind of segmented, kind of we have not become a one large European equity market, kind of but pretty much kind of a Finnish investors are mostly interested in the Finnish kind of equities. Germans are mostly excited about the German equities, the companies, shares, same in Spain, same in Italy, and so on. And for each these markets, new mutual funds have been launched. So for Finnish clients, typically funds, say Aktia offers its funds to Finnish customers mostly. And they are Aktia's funds. Also the European Equity Fund. Say in Germany, there's a German bank offering for German, their own clients, European Equity Fund, which would be offered and tailored and monitored by the German bank. So that's the explanation why we have so many more in terms of number, kind of many more kind of in terms of multiples, number of funds relative to the US. But still we can see the US market is kind of size-wise even bigger than Europe. So it means that per fund, the size of a fund in Europe is much smaller than in the US. So it's, in the long run, it means that the European fund market is not as efficient as American one. In terms of the type of a fund, 34% equity, while money-wise it was the biggest. Number-wise, mixed and other funds, so mostly that is about the balance funds. There are also some guaranteed protected funds, real estate funds and other funds, but mostly these are balance funds, so they invest both in equities and fixed income. The European market, on average, the funds are clearly smaller in terms of size than American. European market has been growing, and there was an article in Financial Times, the one that I found from 2018, which is referring to the European funds assets hitting record of 15 trillion in 2017, 15 trillion European fund assets. Two terms there, usage, which are undertakings for collective investments, rose to 9.7, so with roundings kind of to 10 trillion, and alternative investment funds, which rose to say 6 trillion. So most of the market in terms of assets under management is in something in funds which are called usage. And what is this usage? This is European undertakings for the collective investments in transferable securities, which is there's a directive in Europe, which defines the minimum criteria for a UCITS fund. So this makes roughly 75% of all collective investments, all the funds in Europe. So this is a quality stamp that once you kind of get your fund accepted as UCITS, so you can freely market that everywhere in European Union. So that is kind of there are certain criteria, say diversification minimum, for example, and as one somewhat recent requirement was something called key investor information document. So for each UCITS fund, the fund management company has agreed that they prepare a simplified kind of a prospectus, you could say, of a fund consisting of a investment strategy, would be the benchmark index, all the prices, subscription fee, management fee, redemption fee, custody fee, whatever fees there are. So by just taking a look at this keyed document, investor should get kind of pretty good picture of what this fund is about. It should be somewhat simplified. The rules are somewhat strict, which restrict fund managers' kind of activities. But the idea is that they would be, say, as one diversification minimum, for example, is that you can't invest more than 10% in one stock. So that forces fund management to diversify. And what is that? Is to make these instruments safe enough for any investor. So certain minimum criteria that these UCITS funds all satisfy, they meet. So that is the biggest proportion, somewhat you could say harmonized policies for investment policies and reporting policies for reporting practices for these funds. This is the biggest market in Europe. And the size at the end of 2017 was something like 10 trillion relative to this, 63 trillion globally. So that is a pretty big market. Another, this 5.9 trillion then was alternative investment funds. There's one directive for this as well, which all fund management companies need to follow if they want to, say, as one example could be that that the fund management company says that we do not want to diversify as much as it would UCITS would require. So then you can apply for a kind of a license to run as a alternative investment fund, where investment restrictions are less stringent. But still, kind of those are collective forms. There are still some limits, but they are less stringent than for UCITS fund. That is 5.9 trillion. The size was. Okay, now moving on this. This was 2017. European assets under management in Europe, according to the EFAMA, which is a European kind of a European-wide institution collecting this information of all fund managers in Europe. They have a report from last December, Asset Management in Europe, Facts and Figures. They refer to something called something like 23 trillion. And in 2017, and in the estimate for the third quarter last year was the size would be 31 trillion. The question is that why is this number so different from the previous 15 trillion? The answer is here. This covers, this news covers funds, UCITS funds and alternative investment funds. 15 trillion 2017. while this number, all assets under management. So these are usage funds, alternative funds, plus something called discretionary mandates. So these are investment funds which make something like 55% of the all funds. All funds, all assets under management in Europe, while there is something called discretionary mandates, which is somewhat sizable as well. This investment fund plus discretionary mandates makes this total. So it's not half and half, but it was half and half in 2014. Now the funds share has increased while discretionary has decreased a bit. So that is when in the very first lecture, I told you that one of the goals of this course would be that at the end of the course, we can read Financial Times. Of course, we can read this, but now we also can understand, okay, 15 trillion usage, alternative funds, but doesn't compare if you compare this with the data from European Asset Management, how is this not 15, but this is kind of 23? So, okay, explanation is this contains both all the assets, so both investment funds and discretionary mandates, roughly so. So what is discretionary? This is from Aktia's website, highlights. They also offer the fund management services, but they also offer something called discretionary wealth management, which is more or less that kind of the customer gives for his or her investment banker a mandate, so that investment banker has the right to invest your wealth to make and to make other decisions on its management. So I, as a customer, there's typically kind of some minimum requirement that could be 500,000, 1 million. To go to Swiss bank, it could be 10 million, kind of for you to be eligible to become a customer of discretionary wealth management services. And then you get a dedicated private banker who gets to know you and gets to know your special kind of whatever needs, and you might be interested in kind of say private equity investments or whatever exotic hedge funds or just plain vanilla mutual funds. In terms of investments, they know your kind of cash flows from various sources, and they got to know you, and they form you the portfolio that fits your needs the best. Yeah, you have this dedicated person whom you can ask about kind of how your portfolio has been performing, are there any changes, and if you have changes in your financial position, you can always call her or him. So that is a private banker has the right to make investments on behalf of you. That is discretionary investment. Consultative is kind of the same but different. Same but different. It's that you as a customer, you always make the investment decisions yourself. So that is, you are not delegating. You do not give this right for the private banker, but you could be that kind of you could have earmarked or kind of a private banker or some person in the bank that might consult you and say, okay, now our impression is that Fed will be increasing interest rates. How about kind of selling our growth mutual funds in the US market and put that money in whatever money market funds? That is what we would do, I would do in your position. And then this information is being kind of told to the client, but client makes the decision. So this is consultative wealth management. So this in 2020 made something like 45% in terms of assets, discretionary mandates. Any questions, comments, kind of any experiences? Okay, so as Mikko was referring, Aktia's Mikko was referring that kind of this is the growth area for them. They have the banking business, they have asset management business. They acquired Taaleri Asset Management last year. Was it in May, to grow this business, economies of scale and so. And they also have the life insurance business. So that is asset management seems to be in pretty much as they refer to their business model as, what was that? Wealth management bank. This is from their interim report, assets under management. They had the previous Aktia's assets 10.5 plus Taaleri's 4.7, altogether 15.6 billion. Assets under management has been growing, of course, as a result of this acquisition. This made a big difference. It has been growing somewhat nicely also kind of over the past years. New money has been inflow, new money plus the assets under management, kind of the stock market has been doing pretty well performance-wise also. So assets under management is altogether 18 billion, consisted of customer assets under management. So these are all mutual funds, all discretionary, all consultative, all assets that Aktia advises, plus group financial assets. The bank also has its own investments, and these together make 17.998. Assets under management comprise managed. So this is kind of a detail as such, but they manage their own funds, but they also broker mutual funds, means that, which implies in practice that from Aktia, you can also, via Aktia, you can also invest in other companies' funds than Aktia's own. So Aktia offers you, so they act as a brokerage for you, as a broker for you. If it turns out that Aktia doesn't have, you say, I don't know, you could be interested in investing in Japanese market or whatever, Korean market. Aktia says that we don't have any Korean or Japanese stock fund. So how about kind of we offer you these kind of existing funds, but you can do it via us. There's no need for you to kind of contact these other asset management directly. And then the picture that Mikko presented and then afterwards sent, and this is something that I also put on my courses available there, just took a copy. These are the Morningstar ratings, which is something that Mikko was proud of. And if you look at kind of Helsingin Sanomat or Kauppalehti's cover page over the past week, every now and then, this has been Aktia's kind of commercial kind of advertisement has been there, the whole page. They are proud of their performance. And what is this performance? It's Morningstar rating, which is a third-party rate. It's an independent company which rates mutual funds according to their performance, historical performance only. And it looks that Aktia on aggregate level has been doing pretty well. 5 stars would mean that the fund would be in the best 10%. The average for Aktia's fund seems to be 4.1. So historically, the performance has been very good for Aktia's funds. Is there a question there? Also, Aktia just finalized their. Yeah, Alessandro, corporate finance is a corporate finance. You could say kind of like like an investment bank. That's why was it in yesterday's kind of stock exchange release. So it was finalized. So they acquired 20% of. So they didn't have their own corporate finance operations before. Could be one element in their kind of aim to become to get this 120 million kind of as a net profit in 2025. A question was that has there been any research on the discretionary wealth management versus consultative firm? There's probably higher fees when they have the mandate to control one for. This is a very good question. It's a very good question. First, these are discretionary. So mutual funds, that is a public information. So as these numbers, anybody can observe on a daily basis the performance of a fund. So if you think of yourself as a fund manager, so it's pretty unique of a job as you are a fund manager. So every day, anybody who is interested can follow how was your fund performance yesterday. How did you do your job? And I can tell you, I was in managing director of a fund management company. When the market is rough, when the market is going down, so it can be pretty stressful, kind of. Not only kind of you, of course, you know it as a portfolio manager, your clients knows, but everybody else also, anybody knows. Your neighbor knows, your relatives knows, kind of your competitor knows that okay, your performance is bad. That is public information, but discretionary kind of portfolios, they are totally discreet, so nobody knows them. And it might lead to illusion that kind of as there is this minimum wealth that customer is being accepted to the private wealth services. So in many companies, like I was the managing director for a mutual fund company and the same managing director for a discretionary asset management as well. It was under one umbrella. So decision makers were done by the same portfolio managers. The question there was that we offered these clients of discretionary asset management, the wealthy clients, kind of first some additional features such as trips to Formula 1 races or whatever rally kind of world championships and concerts and so on. So that is kind of something that we didn't offer for mutual fund investors, which were smaller. But the portfolios were kind of the key there was it was not about the performance per se, but it was about kind of the personalized service plus the personalized kind of the portfolio. So that is the key. It's not that the fund managers that in a company the good fund managers would be allocated to the discretionary kind of wealth management services, and the bad portfolio managers would be allocated to mutual funds. No, because mutual funds, they are public information. Kind of it would be simply silly a business decision to put the bad portfolio managers to manage these mutual funds whose performance anybody can see. So discretionary wealth managers, these private bankers, they have different profile, but the investment decisions typically are made by the same portfolio managers in mutual funds and as one example, so that kind of in discretionary asset management services, majority of funds typically is invested in mutual funds. Some of that could be invested directly, but mostly in mutual funds, and obviously mutual funds are the same for anybody. In mutual funds, they are not targeted to retail clients only. If you look at the size, in a Finnish market is relatively public information that kind of only 1/4 is of the capital is invested by retail clients. 3 out of 4, so 75% plus minus is invested by institutions. So Varma, Ilmarinen, and the pension institutions, they also invest in mutual funds. So they are not only kind of retail oriented vehicles, but it looks that also institutional, the most professional institutional investors also find the benefits of mutual funds. So why would not the clients of a discretionary asset management? So the answer to your question is that first, I'm not aware of any such study. If there was such a data, data available from this discretionary asset management kind of portfolios, so I would ex ante expect that the performance is pretty much the same as for the mutual funds. Fees, of course, they vary, and of course, net of fees. If you pay very small, if you manage massive amount of if your portfolio is massive, percentage-wise, you can negotiate pretty small fees, but that is something that you can also do in mutual funds. Mutual funds only have one price, only one management fee. Typically, this is the European practice. In America, they have different kind of series that depend on how much you invest. In Europe, the practice is that it's on one series per mutual fund, typically. But institutional investors can negotiate some discounts still. So fees are very difficult to compare. We have some public numbers, but what customers really pay is not, most of cases, it's not public information at all. So you could say that discretionary asset management services, because they get some additional value, additional kind of offering something more than from this bulk like mutual funds, the fees should be higher, yes. But as the customers are also investing a lot of much more money, say one customer could invest say 50 million. So obviously they also they can negotiate their fees much lower than what would be a customer investing say 1 million or 500,000 or so. Please, any other questions, comments that you might have, please add. Or comment or experiences. If you have been investing yourself, or even you have been working in a, I'm sure many of you, or not many, at least some of you will be working in a mutual fund asset management service in different forms. There are either fund manager or a back office a job would be one alternative, especially early in the career, could be analyst, or could be there are different positions that hopefully you will see, experience yourself at some point of your career. ETFs, okay, you want to start saving, but you're not excited about, you're not interested in the managerial expertise of the fund managers, of these money managers. So then ETF is the solution. So it's index-like, highly liquid, they are listed on stock exchanges. The values of mutual funds are calculated on a daily basis, once a day, while ETFs are traded all day long. So they are the values are updated all the time. So they are highly liquid. While mutual funds, you can buy and sell once a day. Okay, most of the time that is enough of the frequency. But if you are interested in really about the liquid alternative, ETFs are the ones. First index funds came in 1970s. First ETF in US in 1993. There was a ETF in Canada some years back before. Okay, mutual funds pros compared to ETF. Mutual fund pros compared to ETFs. Active money management. I added there in parentheses now, actively managed ETFs. So I don't want to confuse you, but just to make sure that we all understand that mutual funds typically are actively managed. The performance is compared with some benchmark index, some passive benchmark index, but that is just benchmark comparison. While ETFs typically, they mimic the index. So they track the index. So they are passive for investment vehicles. But, and the key is that ETFs, because there is no active management, so the portfolio manager more or less is not needed. So the costs can be minimal. So nowadays you find ETFs whose management fees even as low as 0. While for actively managed funds, we'll see it's clearly above 0, in terms of percentage of the assets, percentage of the annually per annum on assets is typically in Finland typically 1.5, and in US somewhat less than 1. But don't take it as granted that all ETFs are passive, because there are more and more actively managed ETFs being launched, coming to the markets. So some ETFs are actively managed, and the fees also reflect that. So not all ETFs are very cheap, but you should take a look at the keyed, the prospectus of a fund, and see what the fees really are. Typically, mutual funds have been historically in retirement accounts. Most of the money, because they have been offered, is the mutual funds. Sometimes ETFs are not allowed. Mutual funds cons, so they are not listed. It's a daily valuation, and the question is that okay, active money management can be good, or it can be bad. The question is that is it value adding or not? And I'll come back to this in a while. Mutual funds are passive too, correct? Just follow. Yeah, some mutual funds. First, index funds. Index funds, which are more or less the same as ETFs, but they are index funds. Also daily valuation, daily in, daily out, as first index funds. So came in 1970s. Seligson was the first in offering those in Finland. So typically, obviously, they are passive. Majority of mutual funds are active. Then the question is that how active they are. Some of them are, and this is a question of its own. Sometimes you see that they are called. Some of the mutual funds are called closed indexers. So they are following the index very much. Officially say that they publicly say that we are actively managed, but majority of the shares, majority of the money is invested in the big index company. So then the question is it really active management, or is it a closet indexers? They hug the index, as the saying goes. And the question is that okay, this closet indexing is bad for clients if customers pay for active management, but if they are being offered only very close to index, very passive offering, so customers are paying for nothing. And that's why some customers in Denmark, they sued a big Danish company, Danish bank, for saying that you have been misleading us by offering us active funds, but they have been very passive. And the same in Sweden. But this is a question of its own way. You could say that most of the mutual funds are at least relatively actively managed. Index funds typically they are passive. Most of the ETFs are passive, but more and more so also actively managed. So they deviate from the underlying benchmark. Talk about the size. This is from the 2017. I did find a new one. In the US, mutual funds, first fund created 1924, very small market for tens of years, but now it has grown to 18.7 trillion, while ETF market is much more recent. The size at the end of the 2017, 3.4 trillion. From that, ETF market has grown. So mutual fund market so far is clearly much bigger. But this is from the Investment Company Institute. This is in the US, shows the trend that has been going on for some time. In the US market, the new inflows. There has been new inflows in the index domestic equity funds that has been growing since over the past 10 years. Index domestic equity, so American equity ETFs, has been growing even faster. But actively managed domestic equity funds, the money has been flowing out. So this is a big, it has been going on for some time, and this is American data, but typically what happens in the US, sooner or later we will see something happening also in Europe. So and that is, why is that? Many clients have become disappointed for the active management. They have recognized that actually it's either closet indexing, they pay for nothing, or then the funds have been underperforming relative to the index. So why pay for the active management if you get a better result cheaper by investing in index? So this is a trend in the US. Now I see that time is running kind of very quickly, kind of also very interesting statistics from this is about the fees. This is American fees, US fees. Typically the median equity fund, the management fee, expense ratio, so that is a management fee kind of, that's something the fund management company charges, it was 1.08. While for hybrid funds, 1.09, fixed income funds are cheaper. Look at here, index funds, 0.3, 10th percentile is 0.04. Target date mutual funds are kind of, I explained here, there's a fund which is designed to provide a simple investment solution. Say, I'm Vesa, I'm 55, I target to retire in, say, 10 years. So I would feel, if I was not Vesa, if I was not finance professor, if I was not kind of so much interested in kind of investing my money myself, say another Vesa would say, okay, I'm not interested in kind of following the market, but I want to save for the next 10 years. So then I could choose target fund 2032. Which then the fund manager kind of first invests pretty big proportion of that money in equities, but then over the years, the closer we come to the 2032, the majority of the fund will be kind of fixed income instruments because the investment horizon will be shorter and shorter. So those are target date funds, also offered in the Finnish market. The fee median 0.65. Asset weighted averages are clearly less. So if you look at the index mutual funds asset weighted average, so it's only 0.06. So most of the money is invested in pretty cheap the funds, while for active the mutual funds it's 0.5. Hedge funds. Then you will say, okay, mutual funds are boring, ETFs are most boring, I need some excitement in my life. Hedge funds could be kind of a answer for you. What is a hedge fund? Typically, it would be anything that charges 2 and 20. So in many of these hedge funds, the management fee structure is that you pay 2% fixed plus 20% success fee. So anything above some benchmark index, 20% goes to the fund manager. So these are obviously costly kind of products for clients, but still some investors find this fascinating because they are appealing as they are excited about kind of the ability that the fund manager might be kind of providing great returns, as they have in the past. They are unregulated pools of money, so these are not, you cannot, this is something I mentioned on Tuesday, you are not, hedge fund managers are not allowed to offer their funds for retail clients. So these are for kind of institutional clients only. Cliff Asness, who is a hedge fund manager himself, billionaire himself, he's kind of a, he said it kind of a pretty bluntly, pretty openly, that kind of a, it's anything goes, kind of a, these are the rich guys, the fund managers kind of, they never tell in advance what they are doing. They could tell you afterwards what they have been doing, but it's in a way black box. Customer doesn't only relies that kind of, if you invest in Cliff Asness's fund, so I rely on Cliff's ability to beat the market and generate kind of returns. If he's not, so I only can blame myself that I trusted Cliff kind of wrongly. So they're very flexible. They typically, there's a very high activity, very flexible, less liquid. Typically, you can invest in once every 3 months or once a month, or even on an annual basis. You cannot take your money out every day. Like in mutual funds, you can redeem them, you can sell them on a daily basis. Portfolios are very concentrated. Performance fees typically, transparency very low. While in mutual funds, you can every day kind of, on at least on a month basis, you can see where the money is being invested. Minimum investment very high, typically millions, and they are targeted small groups of kind of, say, serious professional investors. Follow different strategies, and very interesting kind of a trend over the recent years has been that some of these fund managers have become like a superstars, kind of a people known in public, like Bill Ackman. I encourage you, if you have a Netflix, was it Netflix, HBO, Netflix, there was a document about Bill Ackman hitting Herbalife as a company. That was a big news kind of a few years back. He made analysis of Herbalife and ended up concluding that Herbalife is a fraud and it will collapse sooner or later. He shorted Herbalife stock with derivatives, and then came public and said, hi guys, so Herbalife will be kind of collapsed. And that was a big thing. This document kind of follows Ackman's kind of route on this Herbalife case as a high profile kind of guys, like his Cliff Asness is somewhat, but especially Bill Ackman. At the end of the day, he lost money, so he was wrong, kind of and he admitted, okay, he left and lost a couple of billions in this Herbalife case, but he has won also. So these big kind of household names, or even Bill Ackman and other hedge fund managers, kind of make big stories in New York. Now the latest, he bought a big stake in Netflix, worth of 1.1 billion. Has been growing, but ETFs, this is already 2016, were exceeding that market. And hedge funds, they used to have been very kind of popular, or very kind of in terms of demand, but the returns have been, as well, they used to be in the 90s, kind of extremely good. Less and less kind of, the performance has become worse. Of the hedge funds, kind of billions is one TV series now running on HBO, kind of that is about the previous rounds were about kind of were about X, kind of who was the hedge fund manager and kind of a somewhat colored and dramatized kind of a thing, or movie or TV series, but that is also kind of a signal that of these hedge managers, kind of documents are being made, movies are being made, prepared, TV series are being made, so they are pretty big. Less so nowadays, as the performance has been somewhat coming back. And this was an article in Financial Times very recently, as recently as this January. So many hedge funds are they have been losing clients. Customers have been disappointed about the performance. Last year they lagged the benchmark US indexes pretty badly. Plus there has been hedge fund have also found difficult to make money, as some bets have been made and disrupted by often hostile retail investors. So these are the meme stocks last year. Wall Street bets, retail investors have been hitting back to these hedge fund managers, which in freely operating market, it's really tough time has been for hedge fund managers recently. Okay, then venture capital and private equity funds, growth has been phenomenal, you could say, in various different private equity. Do you think that the decrease in hedge fund returns is caused by the decrease in the information edge? That's one thing, obviously, but also the market has become, the market has been more democratized, democratic in the sense that all the information must be freely available to everybody. So they have lost the information edge. Plus, there have been many new hedge fund managers coming to the markets. That's one thing, and also the market has been pretty challenging. The central bank policy, all different trading algorithms that were based on historical data. Current environment has been the market environment has been so different for the past 10 years. So many reasons why hedge fund managers have been finding more difficult to find competitive edge in terms of generating alpha. So that is outperformance. Private market has been growing. Venture capital funds, private equity funds. Most common type of private equity funds are venture funds and capital buyout funds, which is a venture capital that typically is treated as separate asset class, but some statistics consider that as a one segment of private equity. It's could be a bit confusing. Early venture capital, how we typically see as a venture fund is that it invests in startup companies in the growth company phase, and then sooner or later it will be doing an IPO or bought by a private equity company. Let's jump here. This shows I get pretty good illustration of the difference between venture capital and private equity. Venture capital invest in very early phase, while private equity companies might target a very mature companies, such as companies who have been operating there for tens of years. Now could be that they're facing some financial challenges. A private equity investor comes and makes a acquisition. Could be delisting, as we will see. One figure here is that many people think that these startup venture capital funds is a guarantee that you make you can multiply your investments, as there are certain cases such as Alibaba, Coinbase, Airbnb, investors have invested pre-exit funding. The valuation has been 2.5 billion, and then when the company has listed, the Facebook's valuation was 100 billion. So massive a upside potential, but there is a huge something for everybody to be aware. So huge selection bias. The story that we are reading from newspapers are the success stories. So they hide the tens and hundreds of different funds and cases which have failed. So on an aggregate level, one relatively recent academic article which looked at all these funds by Kortevak from Annual Review of Financial Economics from 2019, the conclusion was something the same as many academic studies earlier have been found. The average venture capital fund earned positive risk-adjusted return before the turn of the millennium. So it used to be that the returns were massively good, but over the past 20 years, the net of fee returns have been zero or even negative. So venture funds performance has been a challenge for investors. But leveraged buyout funds, so private equity funds kind of concentrating on buyouts, they have generally earned positive risk-adjusted returns both before and after fees. There's some debate, but kind of at least their performance has been better, even also the past 20 years. So that's one reason why private equity, so especially leveraged buyout funds, have been growing, while venture capital funds have been not that popular among institutional investors over the recent, say, 20 years or so. Last, as a case, delistings. Somewhat more common practice that we see is that listed companies are being kind of acquired by a private equity company, like was the case for Melbu Gård. Being the biggest kind of owner of Kappahl, so they announced that they will take Kappahl out from Nasdaq, and that's a family-owned long-term investment. Okay, that affords us to suitable opportunity to set strategic agenda, assume that overall responsibility for company's development. As a non-listed company, the company can more freely kind of operate than as a listed company. This is something that I will conclude today. Just worth kind of thinking that we had a record IPO year in 2021 in Helsinki, but not only companies are doing their IPOs, but if you look at the number of US companies since 1975, from 5,000 to 8,000, almost 8,000, and has been going down for tens of years. Now there's been IPO boom very recently, so new companies have been listing, so there's picked up a bit from 2014. But as there are companies becoming publicly traded, there are more companies delisting. So companies no longer want to be listed, and why is that? You might remember this kind of Tesla's or Elon Musk's tweet that okay, we will. I'm considering taking Tesla private. Funding secured. He never did that, but kind of the idea he explained that as a private company, he agreed then, or he claimed that Tesla would be kind of more successful than as a listed company. So listed company having all these regulations. So why companies do like going private is that to avoid regulation, such as sound-based output, as we got to know. It's flexible. Could be that you can hire top management and report them kind of more freely than, or there's less limitation than in public companies. And the private equity funds used to be somewhat small, but now they have become massive in terms of size, so they can acquire and delist also big companies. So this is a relatively recent phenomenon that we see every now and then, that big private equity companies are announcing that we have bought a big stake in a company and now we plan to delist that. So very interesting kind of recent phenomenon. Question that Samsa is asking about the hedge funds was that could it be easier releasing information of fraud in a company, and so that's one thing also kind of a short, while Bill Ackman, while mutual funds typically they are long only, while hedge funds they can also it's 50-50. They can buy companies, they are short companies, buy derivatives. Their flexibility is kind of much greater than for mutual funds. And as was the case in Herbalife, so Ackman tried to kind of claim that okay, it's a fraud, the whole business model is wrong. Sometimes they're being criticized that by shorting a company's stock, they violate the company's business. Company managers obviously don't like that. Bill Ackman himself has said, okay, he thinks that in a well-functioning capital markets, you would need guys like me who reveal some frauds or whatever mismanagement practices or whatever, you need people like us who actively take positions and then kind of push the stock market kind of to the more realistic level. And it could be that the market hold regulation, now we are not talking about the banking regulation, but other regulation, kind of how companies are required to disclose different information, that has become more transparent. So it's more difficult to find these kind of the companies that misbehave, or it would be public information to anybody earlier than it used to be kind of before. It could be that anyway, kind of, there might be many different reasons, but what we know is that hedge funds performance overall on aggregate has become much less than it used to be, plus 20% nowadays. Of course, there are still some hedge funds doing extremely good, but on average, on aggregate, on average, they are not doing that good. The performance has come down. Any other questions, comments? Today I had kind of too much kind of stuff. I thought that we could kind of cover also investment banks, but kind of we did not. So let's leave investment banks for next Tuesday. Let's first take a look at kind of investment banks, and then the topic will be financial innovation. And on Thursday, then we'll have Eugene Wu talk about the cryptos and himself and his company and everything kind of way. Talking about innovation, that is a big thing, kind of a totally new market. Bitcoin, a bit more than 10 years old, kind of, and looking forward to that. I hope that you find that interesting as well. Any questions, comments? Everything good? Have you been doing your term paper? I've been kind of reading your cases, excellent kind of work. I will comment them kind of a bit later. There are 77 of them altogether. Kind of takes a lot, somewhat time kind of to read them through, but kind of I will come back to those as well